Everybody, welcome to the TraderMerlin Show. It is your Thursday edition, one day closer to that weekend, and yes, as Tom Barr posts on our YouTube channel, happy Thursday to the Bulls, condolences to the Bears. Yeah, today was one of those days where you see a 90-point intraday rally in the S&P futures. Obviously, if you were short, as I am and continue to be, and added to my short position today because I'm not thinking for the next couple days or the next week. I'm thinking of the next couple of months, and I want to make sure I have a sizable position in there. Yeah, it took back a good chunk of profits out there today, but it's fine. Not worried whatsoever. We'll be having a good show in a couple of months as we sell off in the future. Now, interestingly enough, technically there were some really positive signs out there today. So for those of you who are even more bullish and want to be bullish, some of the candle formations were great today, so we'll talk about that. Many of you might be new to this program. Again, we do this show every day at 2 p.m. Pacific, so I would encourage you guys to hit that subscribe button down there. And, of course, if you like the content today, give us always a little thumbs up there. That is always great for me and the channel, etc. Guest for today is going to be Bill Addiss. We're going to talk about the $4 trillion gamble. It sounds like a new series coming out on Netflix, but no, it's something that you and I are living in real life right now. So we'll talk about what that $4 trillion gamble is. We'll also take a look at the most recent comments and announcement from the Fed, see what they're doing, how they're playing their cards, and really, how much deeper they can back themselves into this financial corner that they put themselves in. So that is our show outline for today. Of course, as always, I will be answering questions along the way. Feel free to send those on in on our chat on YouTube. If you are watching this on the podcast right now on iTunes, hello, hope you have a great workout out there. Remember, you can always send in questions at TraderMerlin.com. We'll get to those, incorporate those into the show. You can always put them down below the videos on YouTube as well. All right, I'm probably talking a little bit fast today because I'm excited because we got a lot of fun stuff to look at. I'm going to start off with the Russell 2000, which technically looks the best to me. I actually like it. I really like the formation showing up on the Russell 2000 from a bullish perspective. This is what is called a dragonfly doji. Now, I know it's kind of hard to see. I will probably next week switch over and to a white chart background. I think some of you had requested that, and I think I may actually start to do that here in the near future just because it might be easier for you guys to see. But this candle that formed today, obviously what happened here, it was a very bad day. It was one of those ones I was looking at just laughing, going, man, I didn't think this would be the beginning of the end yet. I thought we'd actually have some more upside move, but we started off real ugly, one giant red candle, and all of a sudden it just came ripping back up to the upside and closing right near its highs. It's called a dragonfly doji when it's a doji, meaning open and closes right around the same price, and then it's a dragonfly because it's almost at the top of this long bottoming tail. So it's not a hammer formation because it doesn't have a real body. Anyway, that is a very bullish sign for the Russell 2000 tomorrow. Of course, there's ways that you're supposed to trade that, which we've already discussed on the show many times in the past. That was your bottom rung, down 0.4 or up 0.45%. So even though you had a very negative day at the beginning, it ended up being a positive day for the Russell 2000. Nasdaq 100 is your next one, up 1.07%. Picture looks a little bit better, but the candle isn't as nice from a purely technical looking pattern formation. You have a nice green candle out there today, a long bottoming tail, but it's not a doji. It's not a gravestone doji. It's not a hammer. It's, it's positive, but technically there isn't anything else there other than the fact that it's over 9,088 right now as we speak. A heck of a day. All right, gold is up 1.28%. Similar picture. The only thing that's noteworthy about gold is we had been kind of talking about it in this, I want to say, kind of a descending triangle, or it's not a descending triangle. Well, okay, we'll call it a descending triangle. And that was this line here. You guys can see that today we actually closed above it, which is a relatively positive thing. Looks good to me to the upside here. We broke above those highs that we established on the 8th of May. And now we're going to be challenging that 1750 mark. And ultimately, I do believe you'll be challenging those highs that we established on April 14th, which will put a high around 1788. All right, let's go to our next one, S&P 500, which was the one that I was in. And you want to talk about a beautiful intraday move. Of course, it was against me, which was, whatever. I try not to watch it all day during the day simply because I know I'm in it for the longer haul. Technically, on the daily, doesn't look like anything really exciting here, right? You have just really sideways action for the better part of 2 weeks. But I want to show you the 5-minute chart because it's one of those ones that you don't see too often, a powerful move like this intraday. That doesn't look like much to many of you. Of course, you look at the scale on this, and when you're looking at one S&P futures contract is $50 per point. We went from trough to peak. I'll give you the exact number. It was a 3.39% rally. Just that alone is pretty impressive, but it moved a total of 93.5 points. Well, just picture this. If we got to 100 points and you had one contract, that's $5,000 per contract. Yes, I have 3 contracts short right now, so that wasn't the best day, but it gave back some of the profit. Still got a really nice winner going, and who knows, I might actually be negative on that one here in the next couple of days, but I'm not worried whatsoever about it. All right, so that's your S&P at 1.25% to the upside today. Bitcoin doing much better. Bitcoin did exactly what we thought it would do, which was rally up to that 10,000 mark. Bitcoin hit it today, came right back down, but still trading at 9,725 on the session. That is where we closed at for Bitcoin, 9,735. Not too bad. But that's not the best performer. Best performer goes to crude oil, which also was just like what we discussed. We discussed it really consolidating. I made it a point that we haven't had a down day in weeks. It's not a down day, a new low in weeks on crude oil. Higher low, higher low, higher low, higher, all the way through here. And today, same thing. We had a higher low, but then it broke above the highs we established back on the 7th of May. And all of a sudden, that thing just popped to the upside. And we saw a nice little, nice rip up. Oh, that's the beeps in the background are Skype reconnecting. I think I have some Skype issues, but we'll get there in a second. But that 9.57% for crude oil today, right now sitting at 27.71. It really doesn't have much in front of it until we get a bit higher. Obviously, that $35 becomes a screaming target for it, but that's $8 away. We'll see if we get there. Anyway, that is your top 7 markets to start the day. Hopefully, some of that put some green into your pockets. I know some of you were actually rather bullish out there, so today was probably one of those days you're going, yes, thank you, some bullish activity finally. One thing to keep a note here, I always like to look at patterns and frequencies and sequences and all kinds of weird combos. If you go back to the lows that we established on the S&P 500, maybe I'll bring the chart back up for you. If you go back to the lows we established on March 23rd, we have not had 3 down days in a row. We've had 2 down days in a row multiple times, I think 3 times. Yesterday was the 4th. But we have not had 3 in a row. So I was kind of thinking this would be an update anyway, just because whatever reason, that pattern keeps coming up over and over again. It seems to have 2 down days followed by a couple of up days. 2 down days followed by a couple of up days. And generally those up days are pretty powerful. So we'll see if that has follow through up to that 2,900 level, which I do believe you'll probably see. Okay, that is your opening sequence out there. Now, the topic du jour is about the entity, well, not a government entity, which has been sitting there backstopping these markets and really forcing them to move to the upside, really giving it no choice. They have been doing so through a wide variety of operations, and our guest, who's going to join us here in just a second, has been giving us some insights as to what those operations are, whether that's buying corporate debt in the primary market or secondary market, all sorts of business bailout initiatives to help them get cheap, easy money. That is the Fed, and the Fed is really doing everything they can right now to stem the bleeding from this coronavirus damage to our economy. Is it enough? I don't know. We all have our opinions on what that looks like and how bad it may get. Right now, I'm calling this the $4 trillion gamble. Joining me today is our guest, Mr. Bill Addiss. Bill, how you doing today?
I am doing great, Merlin. How are you this afternoon?
Fantastic. Great to have you with us. I know you're traveling around and being very busy, so I always appreciate you coming on and joining us for today's show. What have you been up to? Anything new?
Honestly, not so much traveling these days, obviously, but my client base is all the institutional market. I work with the primary dealers and so on, and we've finally been able to move all that business onto virtual platforms. So I'm now living a virtual life, going from Zoom meeting to WebEx meeting, and it's nice to be back training.
It's the new normal, actually talking to people face to face on a regular basis. I'm worried though that there we go. I think your phone you cut out. It's like it does a little weird reconnecting thing. We called this the $4 trillion gamble, Bill. You actually showed me some slides earlier, and I showed this one to my viewers on the weekend edition when I did the chart of the week, and that is looking at this Fed balance sheet, which is pretty crazy. Do you want to walk our viewers through this the chart of the Fed's balance sheet?
Yeah, and thank you. Great to talk to you and your audience again. One thing I just want to clarify first is we've got 2 different things going on here. We've got the government is spending a boatload of money in an effort to stimulate the economy, including the $2.2 trillion stimulus package. Now, when the government does a package like that, we got to pay for it, right? We have to raise money to pay for it. Now, when the Fed does things to help the economy in terms of monetary policy, they get to just print the money to do what they want. And that's exactly what they've been doing for the last 2 weeks in literally unprecedented amounts. You know, as we've talked about at length, you know, on your shows, back in 2009 and 2000 through 2013, the Fed created an awful lot of money and bought an awful lot of treasuries to the point that they had a $4 trillion portfolio. That was the size of their balance sheet. And then as the economy got better, as you see on the chart you're showing, as we got into 2018 and 19, the Fed started reducing its balance sheet, meaning as those treasuries matured, they literally just burned the money. They just destroyed the money. And the size of their balance sheet went down as treasuries were maturing. And now along comes the pandemic. And, you know, the Fed had those 2 Saturday meetings that they met, and they basically have announced that they're going into quantitative easing, and they've given themselves an unlimited pocketbook.
I wish I could do that.
Yeah, wouldn't it be nice to have unlimited overdraft? That's literally what the Fed has given given themselves the opportunity to do. So as a result, the Fed is out there, and I thought we had a good show on.
Uh-oh. You cut out on me. Uh-oh.
We're talking about.
My connection with you is not very good on Skype here, Bill. You keep dropping, but we'll keep going. I got you back now.
Shoot. Okay. I checked my connection. I stayed current, so I'll keep an eye on it.
Okay.
So the Fed's balance sheet has now exploded because, you know, back in 2009 through 13, the Fed only bought bonds. You know, they bought treasury bonds in an effort to drive down interest rates.
Right.
But what the Fed is out there doing now is they're buying everything, literally. The Fed's out there buying treasury bonds. They're buying corporate bonds. As of this week, I'm sure you know, the Fed's now buying junk bonds.
Right. Crazy.
The mortgage-backed bonds. The Fed is buying collateralized loan obligations. And the Fed this week is buying ETFs. I mean, they literally are hoping we can print our way out of this crisis.
Well,
and as a result, I'm sorry, go ahead, please.
Yeah, and I was going to say, if they're buying ETFs, I mean, that is a scary thing because now you are flat out going into the market and propping it up. Because if you're the one buying those ETFs, did they say specifically what ETFs they were looking at? Because I sure as shit don't want to be shorting those ones.
Well, they specifically answer, yeah, I agree with you. And that's one of the reasons agreed, I'm babbling. To answer your question, we don't know the definitive amount as to how much they are buying. What they've said is they're going to focus on the fallen angels. Now, this means literally that bonds last year that were investment-grade corporates that have been downgraded to junk, and it was literally what the Fed has decided to do is to boost up the junk market by buying junk ETFs. And I find it interesting that they have hired a firm to help them with this, and the firm that's helping them with their ETF purchases is BlackRock.
Oh, convenient.
Yeah.
So, you know, I'm out here doing there's one of my favorite scenes from the movie Super Troopers. The cop leans into the window and he's got these 3 kids in the car and they're obviously high and drunk and on all kinds of drugs. And the cop leans in and he's like, "Smell that, Rabbit?" And Rabbit's in one of the name of the other officer and he goes, "That's fear." Yeah, you know, I'm smelling a little bit of fear here, knowing that BlackRock might be behind this, because I just smell a conflict of interest like you wouldn't believe when the BlackRock's going, "Oh, okay, well, the Fed wants our assistance to buy ETFs or the fallen angels, so, gee, would there possibly, I don't know, maybe be a hint of front running going on here?"
No accusations, but I do find it interesting. Yes, I agree with your observation, bottom line. But through all this purchasing that they're doing, the chart that you're showing here has showed what's happened to their balance sheet. You know, the balance sheet of the Fed is now $6.6 trillion. Look at that spike up over on the right side.
Yeah.
And it's continuing to grow literally every day. So the Fed has given themselves an unlimited overdraft to just go out there and try and prop up everything by being the buyer of last resort.
Yeah, and for the viewers out at home, let me draw something on here, because you see, the Fed was doing what they intended to do and what they said they were going to do, which is from 2015, they started announcing the unwinding of their balance sheet. We saw this where you're seeing me draw in red here. And that's the smart thing. They should have been doing that. Now, all of a sudden, we started to see some economic problems. That's this little move up here. I'm going to try to put a box as best I can around this. This was nothing to do with coronavirus. That was zero.
Right.
What you're looking with the coronavirus is the parabolic spike that is directly next to it, that starts right where I'll put this. I'm trying to draw straight lines with a mouse. It's very difficult to do. But that from that line to the right was really a 2-month window of time where they pumped all this money in. That's the crazy part about this, is how quickly and fast it's come in. Notice the moves up. It took years for them back here from 2000, let's say mid-2012 to 2015 to put in $2 trillion in the balance sheets. They've done it in a period of less than 2 months. So to me, this is a little bit scary knowing what the impact of that might be on our markets going forward. Now, you also mentioned something, Bill, the topic that we had today, and I love the doom and gloom aspect of it, which is the $4 trillion gamble. Now, it's not necessarily a gamble when you're the one who's printing money and manipulating the money supply, but walk us through that $4 trillion deficit or the potential for that deficit on the Fed's balance sheet. And I've got your chart here for you, too. Oh, I lost him again. It's funny because it does a little beep, and then he comes right back. And there he is.
Yep. Yeah, I don't know what's going on here. I'm sorry, Merlin.
It's okay. I know when it's coming, so I'll do a color commentary over the
Okay.
3-second drop.
All right. Fair enough.
So walk me through the deficit slide you got.
So now here I have to draw that distinction that I referred to earlier. When we talked about the Fed's balance sheet, that was just the Fed printing up money to buy assets. Now we're talking about the government and the government's finances. And the government is now expecting that they're going to have a deficit of $4 trillion. That we're going to have to issue $4 trillion more in bonds this year than last year just to finance the initiatives and the lack of tax revenue. You know, the economy's at the municipal and government level. That's going to be the next fallout here.
Yeah.
You know, because tax revenue is just abysmal at the federal and state level. So you look at the reduction in tax revenue, but the increase in expenditures through these stimulus packages, we're now going to have a $4 trillion deficit. And do you have the chart up with red?
Yep.
Okay, so if you look, that shows you the deficits going back to 1980. And if you look, back in 2009, we had a deficit of about 1.3 trillion. That's the lowest red bar. But this scale itself only goes up to 1.6 trillion.
Yeah, we've got to double this thing.
Exactly. I mean, this literally is off the charts, in literally speaking. If you put now for 2020 a $4 trillion deficit on this chart, what is that going to look like? I mean, it's a little bit frightening because there is unquestionably, to me, the prospect that this has to result in higher interest rates.
Yeah, that was my next question to you, is when we look at this scenario, what does that paint for you? Because, we talk about the $4 trillion
largest expense the U.S. government.
$4 trillion deficit. You're backing yourself into a corner, and you have to make up that money somewhere, because if we don't make our debt obligations or fix the deficit, it puts us in a downgrade situation where potentially we could see the U.S. get their rating downgraded, which of course would be horrible for most of our paper and financial products out there. What are you there, Bill? He's still dropped. All right. Well, maybe I'll see him pop back on here in a second. It's actually nice. The program I'm using has a nice little bar across the top here, so I can see when they come in or out. So hopefully Bill will be back in just a second here, and I'll get him to answer this question. I don't know why we keep dropping on it, but the question that I have is, at a certain point, you have so much debt, you have so much deficit. How do you fix that? How do we get back into positive territory out there with regards to that instrument? So, unfortunately, did I lose you, Bill? Are you there? Just right in the middle of the show, we lose Mr. Addiss. Let me call him back real quick and see if I can get a call that might work. You're going to get a nice little ringtone out here.
Man, the technology gods are not with us. I'm sorry, Marlon.
Yeah, it's all right. It happens. I've got the technology to call you back and do everything on the fly. I would say I have a great team of staff supporters here helping me out with the internet, but it's all me.
It's you.
All right, I apologize, everybody. It's just a little technological glitch we got. What if they put themselves in a situation with a $4 trillion deficit? What's the solution here? I mean, how do you dig a hole deep enough? How the heck do you get yourself out of it?
Well, that's the discouraging part, because obviously the way you balance a budget, and think of the government's deficit as just an unbalanced budget.
Right.
They've got into overdraft by $4 trillion. Well, the reality is that you solve an overdraft by doing one of two things: you cut expenses or you increase your income. And the unfortunate kind of perfect storm of problems here is both of those are working against us right now.
Yeah.
You know, we're not increasing our income. Tax revenue to the government is down, and yet we're increasing our expenditures through the stimulus programs. And I understand we feel we have to do that, but we just don't have the money for it. So I'm not saying it's gloom and doom, the death of the United States government, but what I am saying is our cost of borrowing money realistically just has to increase in this environment. If we're going to be, it's not that people won't buy treasuries, it's what interest rate are they going to command to buy those treasuries.
Right. And you brought that point up when we had our discussion earlier, which was, in order to get some capital to pay things back and pay just current operations, et cetera, the Treasury is going to have to issue a ton. There'll be a flood of bonds on the market. Now, when you have a flood of bonds in the market, that means that nobody really wants them because there's so much supply. When there's so much supply out there, you're going to have to offer a more attractive yield to get people to buy your paper. Is that the plan from the Treasury?
That is exactly it. And to his credit, Mnuchin, our Treasury Secretary, has been even more specific, because last week when he acknowledged that the deficit will probably hit the 4 trillion mark, he also did acknowledge that they were going to focus on issuing long-term maturity bonds to finance this deficit. Mm-hmm. And as a taxpayer, I'll admit I like that, because if you think about it, the fact that the U.S. government right now can borrow money for 30 years and only pay 1.25% in interest, that's pretty cheap financing. I like the fact the government is issuing longer term. I mean, I don't like the fact they have to borrow so much money, don't get me wrong. But if we got to borrow it, at least let's pay an attractive interest rate. And as a result, that's why next week the government is even going to start issuing 20-year maturity bonds for exactly that same reason. They need to put more paper into the market. They need to increase the supply. So they created a new maturity to try and appeal to new investors. It's all part of the same scheme going on.
Scheme is the right word. You brought up some stuff here. Now, we talked about this last year in August when we saw that inverted yield curve, which was kind of interesting. This is looking at the Treasury yield curves, guys. You can see we got a bunch of different colors that I can't see. It looks like gray was May of 2018. I don't know what that other color looks like. Reddish is kind of 2019, and then the blue at the bottom would be today. You see we had that inverted yield curve, which is generally between the 2 and the 10, but it was here between the 3 and most of the other months. Obviously, we bounced out of that inverted yield curve fairly quickly, and now we're getting back into a more normal yield curve, which you called a steepener opportunity. You want to explain what the steepener opportunity is?
Yeah, thank you. Because the macroeconomics behind this, I think, are really make this an interesting trade. Because if you look at the yield curve that you've got posted, so the blue line at the bottom is today's yield curve. That's where we are today. And it's looking at the major data points of the treasuries in the market. Well, the short end of the market, down here at 1 month and shorter, that's controlled by the Fed, right? Because the Fed, they set the Fed funds rate. That's the short-term interest rate. So think of it like the Fed is holding that end of the string. And that interest rate on the Fed funds rate right now is at 0. And I find it highly unlikely that the Fed is going to be raising that interest rate going into a recession or depression. So I think it's fair to say that interest rate is going to stay where it is. So the short end is kind of the anchor, if you will. But given this abundance and predominance of supply that we're talking about, of long-term paper coming into the market, that's going to result in these longer-term interest rates going higher.
Right.
So what we'll get is, which is what you want. I mean, that's a normal yield curve. You should hope and want the longer you tie up your money, the greater your rate of return is be. So we are expecting the yield curve to go back to normal. So this trade is called riding the yield curve. You want to not make an absolute speculation as to whether rates are going to go up or down, but you actually want to trade the yield differential between one of these short-term interest rates and a longer-term interest rate. Mm-hmm. So in doing the spread trade for what we call the steepener trade, and let's look at it looking at futures for just a moment. What we're saying is we think that the 30-year futures contract is going to go up in yield more than the 1-year T-bill contract. Does that make sense?
Yep.
Thinking of those two data points. So accordingly, to do this trade, you would go short the 30-year bond contract, and you would go long the 1-year T-bill contract. And by doing those trades simultaneously, you're locking in that spread relationship between the short-term interest rate and the long-term interest rate. So if interest rates go up or down linear, you're not going to make or lose any money. The way you're going to make money on this trade is that if the long-term interest rate goes up higher relative to the short-term, which is to say the yield curve steepens.
The steepener opportunity out there. Interesting. All right. A couple questions coming in from the guest out there. And let's see. Where am I at here? Well, let's see. What was the question came through? We talked last year. I think it was last year about who's buying all this stuff, and obviously
right.
It's one thing to be offering tons and tons of treasuries out there, but if you got no buyers, then you have an even bigger problem. And we talked about China being we lost him again.
Nope,
China being the biggest.
We're back.
China being the biggest buyer out there. That was a question that came through here, just so I can give the gentleman the props that asked that. Joseph says, is China still the biggest buyer of U.S. debt?
No, and they haven't been, honestly, for the last 2 years.
Okay.
Ever since we started having tariff wars with China, they cut back on their purchases. And in fact, Japan has jumped up to being the number 2 owner of treasuries again. The holdings of China have dropped down a little bit. Japan has bumped up to the number 2 position, the number 1 position being held by the Fed. So the Fed's number 1, Japan's number 2, China's number 3.
Crazy.
But who's buying them, I think, was the real question. And, certainly foreign central banks. But even if you look at the auction we had yesterday, or yesterday, we had the 10-year Treasury auction yesterday. The dealers themselves wound up buying 22% of the deal, meaning they didn't really have customers who were buying them. They had to buy them themselves. So the dealers are starting to have to sit on more and more inventory as we've got more and more auctions coming down the pipeline. They themselves are having to buy more and more of them.
Let me ask you this. If you have dealers and the Fed, buying, as we would say, don't get high off your own supply, here are the financial drug dealers out there that are getting high off their own supply. I mean, they are now stockpiling this stuff. What's the implication here for a dealer or the Fed if you keep buying this stuff and you end up being the only buyers of it out there and no one else wants what you're selling? I mean, to me, this seems like there's a recipe for disaster there, although we know the Fed can probably bail them out of anything.
Well, and the Fed is, because remember, one of the stimulus programs was directly giving more money to the dealers.
Right.
So that's not a theoretical discussion. That was part of the stimulus package. So that is happening, because you're right. The implication of this is not good. And there's really a twofold implication. Number one is the dealers have to come up with more and more money to carry that inventory. And that's why we had that liquidity crisis that we were starting to experience. Remember when short-term interest rates were going so high? We had that repo problem.
Yep.
We had literally a shortage of cash in the U.S. banking system, because as everybody's starting to have to hold on to more and more inventory, they have to finance it. They have to borrow the money to do that, and that money was literally becoming scarce. So the Fed, as part of the stimulus package, did introduce a lending facility that they are lending money to the dealers at very advantageous terms, like free.
Yeah, like free. There was an interesting comment that came in from Rajwant. Let me get this one up here. Rajwant says, when they print money, do they just give it to the banks and institutions to buy more stocks? How does that help the economy if all they're doing is buying stocks? Rajwant, they're not just giving it to them. They're printing money and then they're going and buying specific products out there. Like we mentioned, they were out there buying treasuries for a while, and then they were buying mortgage-backed securities. Essentially, they were buying things that people didn't want or were afraid of. I mean, who wanted to touch mortgage-backed securities in 2008 and 9 when the housing market was collapsing? No one wanted that garbage. So the Fed said, okay, if that market completely implodes, it could be a systemic risk. We'll come in and we'll buy all this garbage that nobody wants and prop that market up. Then we'll also push the housing prices up with incredibly low rates. Therefore, when this basket of mortgage-backed securities, which was total garbage, at the end of this, it'll actually be okay. We'll make some money on it. So it's almost like they're manipulating the markets for their own accounts here. To me, they're not literally going, here you go, Wells Fargo and JP Morgan. They're generally going and buying assets that are being sold in the marketplace to help prop the market up. And of course, the benefactor would be some of these financial firms that offer those products, right?
Yep. Perfect illustration. I'm not even going to paraphrase it anyway. Perfect.
There you go. All right. What else you got going on? Last time we were on the program, and I'll walk their viewers through this one. Last time we were on the program, Bill was part of a book series, and I wanted to bring this one up again. I'm assuming this offer still stands?
Yeah, through the end of the month, we're able to do it.
Okay, cool.
So another 2 weeks.
These are all books you guys can go find on Amazon.com if you like to play retail prices, or in some cases even higher than retail prices. Generally, you're looking at about $25 per book on Amazon, maybe more. Bill made an offer to us. I said, okay, well, sure. I'm sure you viewers, some of you would love this. It's done by Stuart Vail, who's got the textbook on investments. He's got equities, derivatives, and fixed income investments as one of the books. I actually am in the midst right now, believe it or not, I'm in the midst right now of reading this one, which is derivatives. If you want to know about mortgage-backed securities, credit default swaps, FX swaps, options, futures, a lot of great information in this. He's got an offer right now that if you would like to get all three of those books, which is equities, derivatives, and fixed income investments, go to aftraining.co, and then just go to the store. You can buy the 3-pack of books there for $25, but the coupon code is Merlin. There you go. Now, a benefit of being a Power Trading Radio listener, I guess.
There you go. And I will say, I'm biased because I was hired to edit the books. That's the reason I have an interest here. I'm the editor of the series. But as an introductory to these topics, I think Stu did a great job. But I do stress they're introductory in nature. But for some people who don't know fixed income or derivatives, I think there's a place for that.
Yeah, and I've always been the type of person that if I'm learning something, I'm a hands-on type of person. But usually with that hands-on approach, there is some textbook I can go back through and refresh and look at things that may have been unclear. So the books will definitely help you out there. Again, go to aftraining.co to find out more information on those books. It's a 3-pack there, and just use coupon code Merlin. Bill, tell me about your upcoming schedule. I know you were doing an all asset mastery today for Online Trading Academy, right?
All right.
There you are. What's your what were you do? What's your schedule look like? What are you teaching? I know you did all asset class mastery.
Yeah, no, we're doing the all asset mastery classes every Thursday afternoon. And I also, as I said, my business working with the institutional client base is back online. So it's nice to be in front of the Zoom cameras. What it does mean, though, is I'm not doing as much traveling. So for my LA clients, when I used to come out and visit you guys, I don't know that I'm going to be out there for a while. Everything's being done virtually. So I'm going to miss all those frequent flyer miles I've earned over the years.
Time to save up for trips. Time to save up for trips to Thailand.
Absolutely. There you go. Absolutely. And I've also started, I'm very pleased, and it'll come out in a press conference, but I'm going to be doing a series of classes for the Fed. So I'm very pleased about that.
Wow.
Starting in June, I'm doing a series of classes at the Fed for the Fed. So I'm really looking forward to that.
Wow. Well, since you got connections there, if you ever want to have any Fed guys come on and speak their side of this, because sometimes I'm a little harsh on the Fed. Hey, I wouldn't mind having them on the program, but we've got to put a muzzle on Brendan out there, because Brendan will just start attacking the Fed because he hates the Fed.
There's a lot of that out there. Brendan's in good company, so I feel like some people think I'm going into the belly of the beast by actually training and teaching at the Fed.
Oh, yeah, very cool. Well, I'd love to know more information as that happens. Let us know about this. Is this, you're teaching for the Fed. Is this because they just don't know what they're doing, or what are you teaching them?
They like my style, I guess, because I'm literally teaching them about the Fed.
Here, hire me to teach you your job and what you should be doing, because apparently you're not doing it correctly.
In fairness, it's a very formal new hire program. These are people who are just coming to work at the Fed.
Got it.
Having graduated from business school. So I'm going to work with them for a while and kind of teach them. They have the academic background. I can hopefully bring some practical experience.
Sure. Well, you're getting some nice feedback. Big Eb says, I appreciate your articles you are posting on LinkedIn. So for those of you who might not be have access to all asset class mastery with Online Trading Academy, you can go. He's got articles he posts on LinkedIn. Of course, I'm going to try to get Bill on here a bit more in the future. We get him on. It seems like we've had you on maybe every 3 weeks. I'm going to try to keep that one going here.
You and me both. Let's make it happen.
Sounds good. Bill, thank you so much for joining us today. Have a fantastic evening, and may all your trades be green, my friend. Thanks for the info.
To you too, sir. And everyone stay healthy. Stay healthy. Be well.
All right, take care.
Cheers.
All right, everybody. That was Bill Addiss giving us some insights into stuff that we I think for the most part, many of you already know about, which was looking at the Fed and saying they're putting themselves in a very difficult situation. Of course, I could make the equal point that what else are they going to do? I mean, if they didn't step in right now and do the stimulus that they've been doing, as well as our government, boy, these markets would probably be an absolute free fall, which I'm not opposed to because I'm a trader. Now, of course, a lot of people give me a hard time because they say, well, if you're anti-American because some Americans are going to suffer from a market collapse like this. Well, yes, my attitude has always been you should put yourself in a position to capitalize on any situation. So get those people educated. Let's learn how these markets operate. And the average person won't lose money when the markets crash. They will sidestep it and go to cash, or they will make short trades and make money when these markets drop. So, but I think we would all agree we'd probably be in a much different situation right now if the Fed and our government had done the stimulus. We'd probably be down another 800 points or 1,000 points. So there we go. All right, well, if you guys like Bill Addiss, do me a favor, give me a little thumbs up out there. I'm looking at 28 likes right now. I'm sure we can do better than that. You guys, I think you kind of like that one. Big Eb says, suffer now or suffer more later. I would much rather suffer now and let the market fix itself through experience, and when we come out of it, we'll be way, way stronger. Unfortunately, that's not the way that these things work. We have been in a situation where it's let's cover things up. Let's put more Band-Aids on it. Let's, pump in more heroin into the system so that the pain doesn't hurt anybody. I think we'd be much better off if we actually let the system collapse a little bit and then we reformed around that system to find out exactly what failed and what needs to be replaced or changed. Right now, we can look at our financial institutions, we can look at banks, we can look at certain entities and say some of these companies shouldn't even be there right now because of what they did in previous market crashes. But now they're no longer held accountable for it, so the system won't change. It's just slightly morphed, but it's still going to be a problem going forward. So I'm with you, Big Eb. I think we definitely need to suffer now and be in a better place later on. Jerry says, take the red pill. Take the red pill, the blue pill. With our governments around I say our governments because it's not just myself, it's all of you. Wherever you guys live, you are being manipulated by your governments and central banks out there. Is the new rule of thumb that trend is your friend until you see 300 bearish SPY contract? No. I am simply showing you guys what I'm doing. I feel free to be long and bullish. Like I said, I do actually think the markets are going to continue to go up a little bit. I don't see it breaking 3,000, but the hesitation we had just here the past couple weeks leads me to build a little bit bigger short position. And if it does get to 3,000, I'll be underwater for a little bit. Not too bad, but I'll be underwater for a little bit. But again, I'm looking at 3 months. 3 months, I will be sitting pretty. When we have this probably 2 months. We have this conversation in 2 months. It'll be a much different story, and I'm hoping I'm on the right side of it where I'll still have that position open. And by the way, it's no longer 300, Tom. It's 400 right now, so we're getting a little bit bigger. We only added 100 today, so no big deal. Actually, 120. Cool, Brendan, that's great. I could have very easily have taken profits this morning. That position that I showed you guys yesterday was obviously up considerably, right around 7 o'clock this morning. I mean, it was a pretty amazing winner, but I'm not going to be. I don't want to be day trading and swinging this one. This one is. My eyeballs are looking at September, saying that's when we're going to be going. Wow. Actually, I think it's July when earnings come out, and all of a sudden they revise their forecast. You're seeing now more and more states are putting more quarantine, the stay-at-home orders. I think it just makes the problem even worse. So there we go. Sell my core October 180 puts. Cool. All right, let me just real quickly show this one again. For those of you who may not have purchased it, if you are interested, feel free. These are very, very good books. Again, as he mentioned, they're very basic, but it's good information to understand how all these different asset classes work, all the different components of it. You can get all three of those books for $25 for the bundle at aftraining.co. That's Bill Addiss was the editor on this one, so that's why he's able to give us that discount. So thank you, Mr. Addiss, for not only information today, but giving a little perk and deal to our viewers. All right, let me look and see what we've got for more shorting. Didn't you want the ES to hit higher? It did hit higher. It actually, the way it rallied up today, it was right near the end of the session. So when you look at the way that S&P rallied up, let me just let's go to the file. We'll go 15-minute. So when you look at the way that this one rallied up, oops. As we came into this area here, that was an area I was like, okay, I'll add to that short position because it was right near the end of the day. It was coming in real strong. And I thought, all right, I'm going to add more to it. So I added a bunch to it. And, we'll see. If you look at the daily chart, it still is positive, right? Especially the way the candle formed today. So obviously I'm not feeling super confident about going into it for the next day or two. But again, my objective is what? It's certainly not the next day or two. My objective is going to be these prices way down in here. I mean, look, I've got the 185 puts, but if it got to 2,500, the numbers here would be huge. If we went from our current position at 2847 to 2,500, that position would probably be at 4 times what I put into it. So I'll probably sell some of it out at that point and let the other half run, depending on what month that happens and how much I have left in the contract. I may actually sell and roll into some new ones, but it's all about time for me out there. Let's see. Joe says, oh yeah, Stock Trader's Almanac. Sorry. A great book, by the way. I say it all the time that this book is one of my personal favorites. And it's funny, if you look at the YouTube videos, some of you have been commenting on it. Yes, you can go get this at, I think Alpha, I forgot your full ticker name, but Alpha was on our YouTube channel. He says you can get this on eBay for $3. You can get a lot of these books on eBay for $3, but it's going to be a PDF, right? It's going to be a downloadable one. This is the actual physical book, and there's certain books that I want to have. This would be one of them. You can see over here. I'll show you quickly this little collection. These are some of the books I have. I've got a ton of them in there, right? These are just books. The vast majority of those, I'm not going to read. They just bore me. I could be fine with the PDF on a Kindle because there's nothing really that I want to mark up. This one, when you look at it, I'll just flip over to any page. You look at this book. Every day there's some market quote. There is so much statistical data in here. It's crazy how much data and information is in this book. So I'm a fan of having the actual one, but it's really expensive. This thing, it retails for $50 for this small little book. But, I guess you do years and years and years of data. You got to pay for that data. Let's see. Stock Trader's Almanac. Yeah, 16th edition. I think I have the 2014, so mine's old. I'm sure there's a newer version, but I'm not going to pay to get a new one. And I'll probably reach out to them and see if I can get them on the show, maybe get a free one, as interviewing them on the program. Do you have any particular way that I like to use the Almanac? Did you see Jim Cramer in here? No, there better not be Jim Cramer on myself. I've been given so many books over the years. Now you got me looking over here. Is there really a Jim Cramer book on my shelf? I find it hard to believe just because I'm absolutely not a fan of Jim Cramer. I believe that he lures people into stock trades that they probably shouldn't be in because of his theatrics and showmanship. He's entertaining. He's really good at what he does. But no Jim Cramer over there, Steve. I don't think so. You're going to make me go through my cabinet and check and see if there's a Jim Cramer book. But a lot of those I was given over the years, and yeah, that's it. Really don't read too many of them. No, there isn't really a way that I use this in particular. I love knowing weird little factoids about the market. There's a couple of other instructors that you might have met over the years, certainly generally referencing Online Trading Academy. Jeff Manson's one of those that he knows so many crazy, quirky little market statistics that'll blow your mind. And relationships to... He did make me look. And relationships to markets, asset classes, seasonality. And that's really where I think this one's pretty good, is the seasonality aspect. I do have another one here. One sec, let me show you. This one is also very good. It's the Commodities Trader's Almanac. So if you're looking... Oops, I had the lights in the face. If you're looking at... the commodity side of things, this is great. This talks about seasonality of different asset classes like corn and wheat and soybeans, but it's got a bit more information. How much is this one? Yeah, this is a $50 book as well. Oh, isn't this nice? This might actually be perfect for me. I just found they were a guest in the program a while back, and I just found the contact agent for Wiley & Sons, so maybe I will actually get Wiley & Sons in the program. We can talk about these books. Thank you, guys. Maybe you pull this book off the shelf, and there's the contact I need to get them on the program. Love when a plan comes together. Any Forex books that you could recommend? From a basic perspective, Ed Ponzi, who was a colleague of mine years ago, still great guy. He actually asked about coming on the program. I might get him on. He did some real basic elementary books on Forex that do start to talk about some of the relationships out there. Other than that, I haven't really read any, so I would be remiss if I started saying, hey, this book is great. But I read his, thought they were pretty good, a little bit basic, but sometimes establishing a good foundation is one of the more important pieces. Which was the book that you said is a good read? It's more of a story. That would be Reminiscences of a Stock Operator, which I don't know where I put that one. I've been moving stuff all around in this office. My bookshelf was all nice and orderly until I started doing this show. Now all of a sudden it's all over. It's called The Reminiscences of a Stock Operator. It's a story of Edwin Lefebvre. Actually, it's written by Edwin Lefebvre as the author, but it's really a story about Jesse Livermore. who was a famous trader back in the late 1800s, but it's a great story of market analysis, what he was looking at and how he traded. I would definitely check that one out. Yeah, Jerry says Market Wizards is a good one. I agree. I have Market Wizards here and New Market Wizards. Basically what that one was by Jack Schwager is he goes and he interviews top-notch traders and just asks them some basic questions, and you learn some really interesting things about their behavior, some patterns, things that they do. And what you find out is a lot of these guys are freaking weird, man. They're like savant, weird type of people. But those are pretty good books too. I also, if you're looking for books, we were going to try to get Mark Douglas on the program, who was one of the best market psychologists out there, but he passed away. I had a connection there, and that one failed. But Dr. Alexander Elder and Mark Douglas are two very good books or very good authors with regards to trading psychology, which, to be honest, I think is the most important thing in trading, is the psychological aspect, how you deal with your emotions, how you keep things in check when it's all going to hell in a handbasket. And I think we've all been in those situations where you're in a trade or in a situation and the market or whatever you're in is just tearing you apart, and you feel like it's the end of the world, and you start getting all emotional, you're losing money, and all of a sudden it just gets worse and worse. It's because we didn't just have a plan in place on how to deal with those problems or manage them. So psychology is very, very big. That's why I like having Dr. Woody Johnson come on Power Trading Radio. We'll see if I can get him on this show as well. But anyway, there you go. Brandon, that's a good one. He says the only Forex book needed is the Bitcoin Standard. Yeah, that's a good one. There's also a couple... Andreas Antonopoulos, if you are in the crypto space, he's brilliant with regards to his market information. Falling asleep? Am I putting you down? Do I like John Murphy's books? I haven't read them, so I'll claim ignorance there. eBay has 2020. All right. Let me real quickly show you what's going to be happening for tomorrow. The earnings announcements were nothing spectacular for today. No big deal out there. But we do have some earnings coming out tomorrow. Nothing really spectacular either. I just wanted to bring them up so you can see them. You got JD.com. That's not Jack Daniels, guys. Tokyo Electronics, Japan, Hitachi. A lot of Asian companies. Olympus, Suzuki as well reporting earnings tomorrow, but none of those are probably in your portfolio, so forget about it. Who cares? What is noteworthy for tomorrow is what's going to be going on here with your earnings or economic calendar. There's a ton for tomorrow. Now, I didn't highlight these, but let me just real quickly, if you guys zoom in on the screen here, there is a lot coming out for the U.S. in particular. And what's noteworthy here for me is this number right here. They're saying retail sales negative 12. I think you're going to beat that. I think you're going to see a retail sales number that's worse than negative 12, and that will set our markets off on a nice gap down. Just my guess, and that's all it is. You also have the Empire State Manufacturing Index, which surprisingly looks like it's getting better, right? Remember, it's going back to 50. So this actually looks like it's getting better. And the other one here is industrial production. So we're not basically, everything's come to a grinding halt unless you're Elon Musk and deciding to go back to work. Surprisingly, consumer sentiment is at 68. I find that hard to believe. Business inventories, job openings, all of this stuff just paints a very negative picture. And I think that will be some of the data for tomorrow that we need to keep an eye on. Most of this can be happening by the time you wake up. So by the time markets open, I'll put a little red horizontal line in here. Everything above this red horizontal line, which is kind of straight, that's all happening before market opens. Other than that, you have stuff after market, after the market opens. 30 minutes in is when we get preliminary consumer sentiment, business inventories, JOLTS job openings, et cetera, et cetera. So that's your day for tomorrow. Some decent announcements in there, which I do think will be moving the market. I do expect there to be some volatility, but it won't be from any of the earnings. It'll be from your economic calendar. Retail sales, to me, is the one that's going to be our growing importance as far as our eyeballs and keeping an eye on that one, because as we keep moving forward, if we get worse and worse retail sales, you know what that translates to. More layoffs, which means more job loss. So even if we do come out of this quarantine, those jobs may not be there because retail sales numbers are so down. So to me, it's this beginning of a downward spiral here. It's how quickly can it get stopped? That's the question that none of us will be able to answer, or none can answer right now. All right, any last minute questions? Yeah, so it says automakers besides Tesla are back next week. Yeah, good. I mean, look, there's so many places where you're not going to be within 6 feet of each other. You know, I think that a lot of places should be open back up. There will not be a V-shaped recovery. That's one of the first shows we did, right, Brendan? Remember that? We did, is it going to be a V-bottom, a U-bottom, or an L-bottom? And I think it'll be a U, but a real wide U, like Miami Hurricane U, where you got the leg and then just like sideways for a bit, and then it starts to move back up. I think it's going to take a long, long time. Does retail include e-commerce? Unfortunately, it does. I think we should separate that because e-commerce is booming. I think we would all agree that if coronavirus has done one thing, two things. Number one, it's shown everybody in the world that we can still operate our businesses with remote employees. I know some companies now are saying, don't even bother coming back to the office. We're going to get rid of our office space. So commercial real estate could be taking a big flood of inventory here that nobody wants. The second one is the power of e-commerce and how much business companies like Zoom, Amazon, Shopify, those stocks are going through the roof. Why? Because it's a new paradigm shift. These are the benefactors, primary benefactors from us being quarantined and working from home. So unfortunately, those retail sales numbers do include that. But what there is there's a report that comes after, and you'll see a breakdown of brick and mortar stuff versus internet. And it's a brick and mortar stuff. It's just going to be slaughtered. It's going to be an absolute bloodbath. So if I can, tomorrow I will... if I get some time, I'll break that down and maybe we can look at the details of that report and see exactly where those growth numbers are coming from, or how quickly it's declining in that retail, mall type of space. Yeah, commercial real estate is a nerve-wracking one. Stupid companies will be compelled to keep redundant real estate. There's always an opportunity out there, and again, I think the opportunity is going to be in shorting retail stocks. All right. That'll do it for today, everybody. Again, if you like the show, you like Bill Addiss, go ahead and click that thumbs up button. We always appreciate that. For those of you who might be new to the show, I would encourage you to also click the subscribe button or the little bell. I do the show live every day at 2 p.m. Also, Saturday morning, I upload a video called The Chart of the Week, and I will hopefully, if I can get some more free time to do all this stuff, because it's a lot of work. It's so funny. I've had some complaints lately about the quality and things. I'm going, guys, I'm doing this on myself, so relax. We'll get there. At some point, we'd love to get a team together that I can offload some of the resources, and then we can start cranking out videos like crazy. But I have a whole idea for a bunch of series of videos. Keep an eye on that TraderMerlin site, and I'll be posting those there. Of course, if you guys watch the show regularly, you will know because I will tell you about what's coming out. All right, everybody, thank you so much for joining us today. Have a fantastic evening. I'll see you tomorrow with not a glass of Pappy Van Winkle, Big Ab, but I'll have a nice glass of whiskey for tomorrow's show. Till then, happy trading, everybody. I'll see you tomorrow.